Before we begin, please remember that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The world of finance and mortgages is complex and highly personal. The information in this video should not be considered financial, legal, or tax advice. Always consult with a qualified professional, like a certified financial planner or a mortgage broker, before making any decisions about your own financial future. Your situation is unique, and you deserve advice tailored specifically to you. The single biggest financial mistake you can make in your lifetime is not buying a house. It's choosing the wrong mortgage to buy that house. That one decision, made under pressure in a small office over a mountain of paperwork, can be the difference between building generational wealth and being trapped in a 30-year cycle of debt that costs you hundreds of thousands of dollars more than it should have. Think about it. You spend months, maybe even years, saving for a down payment. You sacrifice vacations, you skip dinners out, you drive an older car. You scour the listings, you go to a dozen open houses, you finally find it, the one. The house with the perfect backyard for the dog, in the right school district. You feel this incredible rush of excitement and relief. And then you're handed a stack of documents filled with the language you don't understand. FHA, VA, conventional 5-to-1 arm, jumbo points, escrow. Your mind is spinning. The real estate agent is excited, the seller is eager, the lender is smiling. Everyone wants the deal to close. And in that moment, most people just sign on the dotted line, trusting that the standard option is the best one for them. That trust, that single moment of confusion and pressure, is where fortunes are lost. This is not a test you want to fail. The stakes are just too high. But here's the good news. It's not nearly as complicated as they want you to think it is. The entire mortgage industry is built on a foundation of confusing terms and acronyms, designed to make you feel like you need them to translate it all for you. But you don't. My promise to you is this. By the end of this video, you will have the clarity and confidence to walk into any lender's office and understand exactly what's being offered to you. You won't just know the names of the different mortgages. You'll understand the strategy behind each one. You'll know who they're for, who they're not for, and the hidden traps to watch out for. You will be in control of the single biggest purchase of your life, empowered to choose the loan that builds your wealth, not the banks. So let's pull back the curtain. In the United States, almost every home loan falls into one of two giant buckets: fixed-rate mortgages and adjustable-rate mortgages. That's it. That's the big secret. Everything else is just a variation on one of those two themes. And we're going to start with the undisputed king, the heavyweight champion of American homeownership, the 30-year fixed-rate mortgage. If the American dream had a financial product, this would be it. Over 70% of homebuyers in the U.S. choose this loan. It's what your parents probably had. It's what Dave Ramsey preaches on the radio. It is the bedrock of the American housing market. And the concept is beautifully simple. You borrow a lump sum of money to buy your house, and you agree to pay it back over 30 years, or 360 monthly payments. The fixed rate part is the magic ingredient. The interest rate you have on day one is the exact same interest rate you will have on day 10,950. It never changes, ever. If you lock in a rate of 6.5%, it will be 6.5% when your kids are in kindergarten, and it will still be 6.5% when they're graduating from college. The appeal of this is purely emotional, and it's incredibly powerful. It's about stability, predictability, peace of mind. In a world where the price of gas, groceries, and everything else seems to change every week, your mortgage payment, the single biggest line item in your budget, remains a constant, reliable anchor. You know exactly what your principal and interest payment will be this month, next year, and in the year 2054. This makes budgeting a dream. You can plan your life around this number with absolute certainty. It's the set-it-and-forget-it approach to homeownership, and there is immense psychological comfort in that. Feels safe. Feels responsible. Another massive, often overlooked benefit of the 30-year fixed is that it's a phenomenal hedge against inflation. Think about it. Your payment is fixed in today's dollars. But over the next 30 years, it's very likely your income will go up. The cost of everything else will go up. The value of a dollar will go down. But your house payment stays the same. That $2,500 a month payment that feels a little tight today might feel like an absolute bargain 20 years from now, when your salary has doubled and a loaf of bread costs 15 bucks. Your housing cost effectively becomes cheaper over time relative to your income. That is a massive passive wealth building tool. So if it's so safe, so predictable, and so popular, what's the catch? Why doesn't everyone just get this loan and call it a day? Because that safety and predictability come at a staggering price. The two major downsides of the 30-year fixed mortgage are the slow growth of your equity and the colossal amount of interest you pay over the life of the loan. Let's talk about equity first. Equity is the part of the house you actually own. It's the difference between what your house is worth and what you still owe the bank. Building it is the primary way homeowners build wealth. But with a 30-year loan, you build equity at a glacial pace, especially in the beginning. Why? Because of something called an amortization schedule. The bank structures the loan so that in the early years, the vast majority of your monthly payment goes directly to paying off the interest. Only a tiny sliver goes toward paying down your actual loan balance, the principal. Let's use a real-world example. Say you take out a $400,000 loan at a 7% interest rate. Your monthly principal and interest payment would be about $2,660. Sounds reasonable. But in your very first month, do you know how much of that payment actually goes to paying down your $400,000 debt? About $327. That's it. The other $2,333 is pure interest, straight into the bank's pocket. After 5 years of making payments, that's 60 payments, totaling nearly $160,000 out of your pocket, you will have only paid off about $24,000 of your original loan. You've paid the bank $160,000. And your debt has only gone down by a tiny fraction. You're essentially renting money from the bank for the first decade. And that brings us to the truly mind-blowing part, the total interest paid. That 30-year term, which provides so much comfort, is also a brutally efficient machine for transferring wealth from you to the lender. On that same $400,000 loan at 7%, if you keep it for the full 30 years, you will pay the bank approximately $558,000 in interest alone. Let me repeat that. You borrowed $400,000. You will pay back the $400,000 plus another $558,000 on top of it. You ended up paying $958,000 for your $400,000 house. You paid more in interest than the house was even worth. You bought the bank a house and then you bought your own. That is the hidden cost of 30 years of safety. So the 30-year fixed mortgage is a fantastic tool for people who value maximum stability and predictability above all else. And for those who plan to stay in their home for a very long time. It gives you a payment that will never surprise you and acts as a great inflation shield. But it comes at the cost of slow equity growth and an astronomical amount of total interest paid. It's the marathon of mortgages, slow, steady, and incredibly expensive in the long run. But what if there was another way? What if you could get the same safety and predictability of a fixed rate, but treat the race like a sprint instead of a marathon? What if you could pay off your house in half the time, build equity at lightning speed, and save literally hundreds of thousands of dollars in interest? Well, you can. Welcome to the world of the 15-year fixed-rate mortgage. This isn't just a loan. It's a wealth-building machine disguised as a home financing tool. It's the 30 years ambitious, overachieving younger sibling. It's for people who see debt not as a tool, but as an enemy to be conquered quickly and decisively. Think about it. The average American gets their first mortgage around age 36. With a traditional 30-year loan, they won't make their final payment until they're 66 years old, right on the doorstep of retirement. They spend their entire working life sending a check to the bank. But with a 15-year loan, that same person is mortgage-free at 51. Imagine that feeling. Being in your early 50s, at the peak of your earning potential, with your single biggest expense completely eliminated from your life. That isn't just financial freedom. It's a fundamental life upgrade. The money that was going to the bank can now be supercharged into retirement accounts, travel, starting a business, or helping your kids with college. You're not just paying off a house. You're buying back 15 years of your financial life. So how does it work and what's the catch? Let's use the same $400,000 house we talked about before. With a 30-year mortgage at, say, 6.5% interest, your monthly principal and interest payment is around $2,500. Over those 30 years, you'll pay the bank over $500,000 in interest alone. Your $400,000 house will actually cost you more than $900,000. Now, let's run the numbers on a 15-year fixed-rate mortgage. The first thing you'll notice is that banks offer you a better deal. They see you as less of a risk because they get their money back faster. So, instead of 6.5%, you might get a rate of 5.75%. Your monthly payment will be higher, no doubt about it. It would jump from $2,500 to about $3,300 a month. That's an extra $800. And for most people, that's where the conversation ends. They see that higher number and immediately think, I can't afford that. But they're missing the big picture. They're focused on the battle, not the war. Because what happens when you make that higher payment for 15 years? The total interest you pay the bank drops from over $500,000 to less than $200,000. Let me say that again. You save over $300,000. That is a brand new Ferrari. That's a college education for 2 kids. That's a life-changing amount of money that stays in your pocket, not the bank's. You're building equity at a blistering pace. In the first 5 years of a 30-year loan, you've barely made a dent in what you owe. The vast majority of your payment is just feeding the interest monster. But with a 15-year loan, you are attacking the principal from day one. Your net worth skyrockets. This is the mortgage for the financially disciplined. It's for the dual-income household with stable careers who are determined to reach financial independence. It's for the person who just got a big promotion and decides to throw that extra income at their housing debt instead of upgrading their car. It's for the empty nesters who are downsizing and want to own their final home outright before they even think about retiring. It forces you to live within your means because the payment is non-negotiable. It's a mandatory savings plan that builds wealth in an asset you own. But, and this is a huge but, it is not for everyone. The 15-year mortgage is a powerful tool, but it's also a rigid one. That $800 a month difference in our example is the entire story. It's the price of admission. If that higher payment stretches your budget to the breaking point, you are setting yourself up for disaster. You become house poor, where every dollar you make is consumed by your mortgage, leaving nothing for savings, emergencies, or even a little bit of fun. What happens if one of you loses a job? What happens if the furnace breaks or the roof starts leaking? With a 30-year loan, that lower payment gives you breathing room, gives you flexibility. You have an extra $800 a month you could be saving in an emergency fund, investing in the stock market, or using to handle life's unexpected curveballs. This brings us to a crucial concept financial experts call opportunity cost. The big question is paying down your mortgage the absolute best thing you can do with that extra $800? A mortgage rate of 5 or 6% is relatively low-cost debt. Historically, the stock market has returned an average of around 10% per year over the long term. So, a savvy investor might argue that you're better off taking the 30-year loan with the lower payment and investing that $800 difference every single month into a simple S&P 500 index fund. Over 15 years, that investment could potentially grow to be worth far more than the interest you would have saved on the mortgage. You'd have a smaller chunk of your house paid off, but you could have a much larger pile of money sitting in your brokerage account. It's a classic debate: guaranteed return versus potential return. Paying down your mortgage is a guaranteed risk-free return equal to your interest rate. You know you're saving that 5 or 6%. Investing in the market has the potential for much higher returns, but it also comes with risk. There's no right answer. It's about your personal tolerance for risk and your financial goals. Do you want the psychological comfort and guaranteed win of a paid-off house? Or do you want to leverage low-cost debt to potentially build even greater wealth elsewhere? The 15-year fixed-rate mortgage is about brute force. It's about sacrifice now for a massive reward later. It's for the sprinter. But what if you're not a sprinter? What if you can't afford that higher payment, but the idea of paying interest for 30 long years makes you sick? What if you know you're only going to be in this house for 5 or 7 years before you move for a new job or a growing family? Paying all that interest up front on a 30-year loan feels like setting money on fire. What if there was a third way? A hybrid option? A mortgage that starts with an incredibly low, almost teaser-like interest rate for a few years, giving you the lowest possible monthly payment, but with a ticking clock attached. A loan that lets you game the system, saving you thousands in the short term, but that holds a massive risk if your plans suddenly change. What if you could get the best of both worlds? But only if you know exactly when to get out. This hybrid, this financial chimera, is known as an adjustable rate mortgage or ARM, and it's one of the most misunderstood and potentially powerful tools in the entire real estate world. It's not a simple 30-year contract. It's a loan with 2 distinct phases, a story with 2 acts. The first act is the honeymoon period. The second act is the great unknown. Let's break down the code. When you see an ARM advertised, it comes with a name that looks like a fraction, like 5/1, 7/1, or 10-1. This isn't just jargon. It's the entire rulebook for your loan, condensed into 2 numbers. The first number is the golden ticket. That's the number of years your interest rate is locked in, completely fixed and predictable. For a 5-to-1 ARM, you get 5 years of stability. For a 7-to-1 arm, you get 7. During this introductory period, the rate is almost always significantly lower than what you could get on a 30-year fixed mortgage at that same moment. This is the bait. This is the incredible short-term advantage. For those first 5, 7, or 10 years, your monthly payment is lower, sometimes dramatically so. You're saving hundreds, maybe even thousands of dollars a year, freeing up cash flow, and allowing you to afford more house than you otherwise could. It's the closest thing to a financial cheat code in the housing market. But what about that second number? The one in May 1st or July 1st? That's when the clock strikes midnight. That's when the honeymoon is over. The second number tells you how often your interest rate can change, or adjust, after the initial fixed period is up. In most cases, it's a 1, meaning the rate can change once every year for the rest of the loan's term. So, on a 5-to-1 arm, you have 5 years of calm, followed by 25 years where your interest rate is a moving target, resetting every single year. This is where most people get scared and tune out. But understanding how it adjusts is how you master the game. Your new fluctuating rate isn't just pulled out of thin air by a banker. It's calculated with a simple formula. Index plus margin. That's it. Let's demystify those two words. The index is an independent, publicly available benchmark interest rate that reflects general market conditions. Think of it like the wholesale price of money. The most common one used today is called the SOFR, or the Secured Overnight Financing Rate. You don't need to know how it's calculated, you just need to know that it goes up and down with the economy. It's the tide and your mortgage is the boat. The second part of the formula is the margin. This is the bank's profit. It's a fixed percentage that is added to the index. When you sign your loan documents, that margin is locked in forever. It will never change. So, if the SOFR index is at 3% and your margin is 2.5%, your new interest rate for that year is 5.5%. If the index climbs to 4% the next year, your rate becomes 6.5%. The margin is the bank's constant. The index is the economy's variable. Now, you're probably thinking, what's to stop the index from skyrocketing and my payment from doubling overnight? That's where the most important safety feature of an ARM comes in. The caps. These are the built-in circuit breakers that limit how much your interest rate can possibly change. There are 3 of them and they are your best friends. First, you have the initial adjustment cap. This controls how much the rate can jump the very first time it adjusts after your fixed period ends. It's often capped at 2 or 5%. So if your starting rate was 4%, it can't suddenly leap to 12%. It might go to 6%, but it can't go past its initial cap. Second, there's the periodic adjustment cap. This limits how much the rate can change in any subsequent year. This is usually around 2%. So if your rate adjusts to 6% in year 6, in year 7 it can't go any higher than 8%, no matter what the market index is doing. It's a buffer against extreme volatility. Finally, and most importantly, is the lifetime cap. This is the absolute ceiling. Your interest rate can never, ever go higher than this number over the entire life of the loan. It's often set at 5 or 6% above your initial starting rate. So if you start with a 4% ARM, your rate will never, under any circumstances, exceed 9% or 10%. It gives you a worst-case scenario. You know the absolute maximum your payment could ever be. So, who on earth would sign up for this kind of calculated uncertainty? The answer is someone with a plan. An ARM isn't for the person who wants to buy a house, settle in for 30 years, and never think about their mortgage again. That person needs the peace of mind of a fixed-rate loan. An ARM is a strategic tool for a specific type of homebuyer. Think of a young doctor just finishing her residency. She's earning a modest salary now, but she knows in 4 or 5 years, her income is going to triple when she becomes an attending physician. A 5-to-1 ARM is perfect for her. She gets a super low payment during her lower earning years, allowing her to buy a home sooner. When the rate is about to adjust in 5 years, her income will have exploded. At that point, she can easily afford the potentially higher payment, or more likely, she'll just refinance into a 15-year fixed mortgage and pay the house off aggressively. She used the ARM as a bridge to her future financial self. Or consider a military family that just received orders to a new base. They know for a fact they will be there for 4 years before they have to move again. Why would they pay the higher interest rate on a 30-year fixed loan when they have zero intention of being in the house for more than a few years? A 5-1 or 7-1 ARM is tailor-made for them. They get the benefit of the low initial rate for the entire time they own the home, and they sell the property long before the first rate adjustment ever hits. They played the system and they won. The danger of arms, the ghost that haunts this loan type, is the ghost of 2008. The financial crisis was fueled in part by exotic, dangerous versions of these loans, arms with teaser rates that were artificially low for 2 years, or even worse, loans where your payments didn't even cover the interest, causing the loan balance to grow larger every month. Those predatory products are largely gone now thanks to new regulations, but the lesson remains. If you take on an arm without a clear exit strategy, if you hope you'll be making more money, or you hope you'll move, you are gambling with your home. Life happens. People lose jobs, promotions fall through, plans change. If you're still in an arm when the rates start adjusting and you're not financially prepared for that worst-case scenario payment, you can find yourself in a world of trouble. The arm is the specialist's scalpel, not the homeowner's hammer. It offers incredible benefits if your life's timeline aligns perfectly with its structure. You can save tens of thousands of dollars, but it demands that you are honest with yourself about your future and have a backup plan. It's a loan for the chess player, not the checkers player. But what if you don't have that kind of predictable 5-year plan? What if you need a low down payment and your credit isn't perfect? What if you need a loan that offers not just a low rate, but a helping hand from the government itself? Then you need to meet the FHA loan. It's not a loan from the government, that's a common mistake. It's a loan from a regular bank, just like a conventional loan, but with a powerful invisible cosigner: the United States government itself. Think of it like this. Imagine you want to borrow $100 from a friend, but that friend is a little hesitant. They don't know you that well, and they're worried you might not pay them back. Now imagine your other very wealthy and very trustworthy friend steps in and tells the lender, "Hey, go ahead and give them the money. I personally guarantee that if they can't pay you back, I will." Suddenly, the lender isn't nervous anymore. They're not just lending to you. They're lending to you with a safety net provided by someone they absolutely trust. That's exactly what the Federal Housing Administration, or FHA, does for homebuyers. They don't give you the money, they give the bank an insurance policy. A promise that if you, the borrower, default on your loan, the FHA will cover the bank's losses. This single act of insurance changes everything. It completely transforms the risk equation for the lender, allowing them to say yes to people they would otherwise have to turn away. It's the single biggest key that has unlocked the door to homeownership for millions of Americans since it was created during the Great Depression. So what does this government guarantee actually get you? Well, it starts with the single biggest hurdle for most aspiring homeowners: the down payment. We've all heard the myth that you need 20% down to buy a house. On a $300,000 home, that's $60,000 in cash. For most people, that's a mountain too high to climb. The FHA loan looks at that mountain and hands you a jackhammer. With an FHA loan, the minimum down payment is just 3.5%. Let's run those numbers again. On that same $300,000 home, a 3.5% down payment is $10,500. Now that's still a lot of money, but it's not $60,000. It's a goal that feels achievable. It's the difference between maybe someday and maybe next year. This dramatically shortens the time it takes for a regular person working a regular job to save up and finally get their foot in the door of their own home. But the FHA's helping hand doesn't stop there. The second major barrier to buying a home is your credit score. Life happens. Maybe you had a medical bill go to collections, or you were late on a credit card payment a few years ago. Conventional loans can be very picky about this. They want to see a pristine credit history, typically a score well into the high 600s or 700s to get a good rate. The FHA program was designed for people who don't have a perfect financial past. Because the loan is insured by the government, lenders are willing to be much more flexible. You can often get approved for an FHA loan with a credit score in the low 600s, and sometimes even as low as 580, and still get that 3.5% down payment. This doesn't mean your credit doesn't matter. It absolutely does, and a higher score will always get you a better interest rate. But it means that a few past mistakes don't automatically disqualify you from the American dream. The FHA also offers more leeway on something called your debt-to-income ratio, or DTI. This is one of those boring financial terms that is actually incredibly important. Your DTI is simply a percentage that shows how much of your monthly gross income goes towards paying your debts, things like your car payment, student loans, and credit card bills. Lenders use this to gauge whether you can truly afford to add a mortgage payment to your monthly budget. A conventional loan might have a strict cap, say at 43%. If your existing debts plus your new potential mortgage push you to 44%, you're denied. End of story. FHA guidelines, however, are often more generous. They might allow that DTI to stretch up to 50%, or in some cases even higher. That little bit of extra breathing room can be the critical difference that pushes an application from denied to approved. So you're getting a low down payment, flexible credit requirements, and a forgiving DTI ratio. Sounds almost too good to be true. And in finance, whenever something sounds too good to be true, you have to ask, what's the catch? With an FHA loan, the catch has a name: Mortgage Insurance Premium, or MIP. Remember that insurance policy the government gives the lender? You, the borrower, are the one who has to pay for it. And this is where the FHA loan can become significantly more expensive over the long run compared to a conventional loan. This FHA mortgage insurance comes in two parts. First, there's an upfront mortgage insurance premium. This is a one-time fee, currently 1.75% of your total loan amount, that's usually just rolled into your mortgage. So on a $300,000 loan, you'd have an extra $5,250 added to your principal balance from day one. You don't pay it out of pocket, but you do pay interest on it for the life of the loan. The second part is the one that really stings. It's the annual mortgage insurance premium, which is paid in monthly installments as part of your mortgage payment. This is an ongoing cost, and here's the critical piece of information you cannot forget. If you put down less than 10% on an FHA loan, which is what most FHA borrowers do, you will pay that monthly mortgage insurance for the entire life of the loan. It never goes away. 30 years. Whether your home value doubles or you pay your loan down to the last dollar, that MIP payment will be there every single month. This is the fundamental trade-off of an FHA loan. You get into a house with less money down and a lower credit score, but in exchange you pay a permanent insurance fee that a conventional loan borrower might only pay for a few years or not at all. It's the price of admission, the cost of that government cosigner. For many, it's a price they are more than willing to pay. The ability to stop paying rent and start building equity years earlier is often worth far more than the extra cost of the MIP. The only way to get rid of FHA MIP is to sell the house or refinance into a different type of loan, like a conventional loan, once you have enough equity built up. So who is the perfect candidate for an FHA loan? It's often the first-time homebuyer who has a steady job but hasn't had the time to save up a massive down payment. It's the young family that needs more space but has student loan debt affecting their DTI ratio. It's the person who is diligent about paying their bills now but had a rough patch a few years back that's still weighing down their credit score. The FHA loan is a bridge. It's designed to help people who are ready for the responsibilities of homeownership but are blocked by the rigid requirements of the conventional mortgage world. It's a powerful tool, a testament to the idea that homeownership shouldn't be reserved only for those with perfect credit and a huge savings account. It has its costs and its trade-offs, absolutely. But for millions of Americans, the FHA loan wasn't just an option. It was the only option. It was the key that finally opened the front door. But as powerful as this program is, there's another government-backed loan that is, for those who qualify, arguably the single greatest mortgage product ever created. A loan so beneficial, it's considered one of the most valuable financial perks earned through profound service to our country. A loan that allows you to buy a home with absolutely zero money down. I'm talking, of course, about the VA loan, guaranteed by the U.S. Department of Veterans Affairs. This isn't just a mortgage product, it's a promise. Thank you. A tangible benefit earned through sacrifice and dedication to our nation. It was born from the Servicemen's Readjustment Act of 1944, a piece of legislation that would forever change the American landscape. You probably know it by its more common name, the GI Bill. The original GI Bill was designed to help World War II veterans adjust to civilian life. It provided tuition for college, unemployment benefits, and, most critically for our conversation, federally guaranteed home loans. The goal was to prevent the widespread unemployment and economic turmoil that followed World War I, and to give returning heroes a real, tangible stake in the country they fought to protect. It was an investment in people, and it paid off in ways no one could have imagined, fueling the post-war economic boom and the rise of the American suburbs. Today, that promise lives on in the form of the VA home loan. So, who is this incredible benefit for? The eligibility list is specific, as you'd expect. It's primarily for active duty service members, veterans who were honorably discharged, and certain surviving spouses of service members who died in the line of duty or as a result of a service-related disability. There are specific time and service requirements depending on when and for how long you served, whether in wartime or peacetime. If you think you might be eligible, the first step is to get a certificate of eligibility, or COE, from the VA. This is the golden ticket, the document that proves to a lender that you have earned this benefit. Now, here's a crucial point that trips a lot of people up. The VA doesn't actually lend you the money. You don't walk into a VA office and ask for a home loan. Instead, the VA guarantees a portion of the loan that you get from a traditional private lender like a bank or a mortgage company. Think of the VA as the ultimate co-signer. They say to the bank, "Hey, lend to this veteran. If for some reason they can't make their payments and the loan goes into foreclosure, we've got your back. We will cover a portion of your losses." This guarantee is the secret sauce. It's the magic that makes all the other incredible benefits possible. Because the lender's risk is drastically reduced, they are willing and able to offer terms that you simply cannot find anywhere else. Let's break down those game-changing benefits. First, the one we just teased, the zero down payment. For most conventional loans, you need at least 3 to 5% down. For an FHA loan, it's a minimum of 3.5%. On a $400,000 home, that's $14,000 to $20,000 you need to save up just to get in the door. For many military families, who often move every few years and may not have high-paying civilian jobs, saving that kind of cash is a monumental task. The VA loan eliminates that barrier completely. If the home appraises for the sale price, an eligible veteran can finance 100% of the purchase. This is, without a doubt, the single most powerful feature of the loan. It has opened the door to homeownership for millions of veterans who otherwise would have been stuck renting for years. Second, and almost as important, is no private mortgage insurance or PMI. As we've discussed, if you get a conventional loan and put down less than 20%, you have to pay PMI every single month. It's insurance that protects the lender, not you, and it can add hundreds of dollars to your monthly payment. With an FHA loan, you pay a similar thing called a mortgage insurance premium, or MIP, for the entire life of the loan in most cases. The VA loan has no monthly mortgage insurance whatsoever. None. This isn't just a small savings. Over the life of a loan, this can save a veteran tens of thousands of dollars. It directly translates to a lower monthly payment and more money in your pocket. Third, the VA loan typically comes with very competitive, often lower interest rates. Again, this goes back to that government guarantee. Less risk for the lender equals a better rate for the borrower. A lower interest rate, even by a fraction of a percent, can save you an enormous amount of money over 30 years. Fourth, the VA actually limits the closing costs that lenders can charge to veteran borrowers. They have a clear list of what are called non-allowable fees, which helps keep the out-of-pocket expenses required to close the loan as low as possible. And here's a big one that people often get wrong. The VA loan benefit is reusable. It's not a one-and-done deal. You can buy a home, live in it, sell it, and then use your VA benefit again to buy another home. You can even, in some cases, have more than one VA loan at a time, depending on how much of your entitlement you've used. This is a lifetime benefit you have earned. So zero down, no PMI, great rates, lower closing costs, it sounds perfect. Too good to be true, right? Well, it's not too good to be true, but there are some very important things to understand. It's not a free-for-all. The biggest catch, if you want to call it that, is something called the VA funding fee. This is a one-time fee paid directly to the Department of Veterans Affairs to help keep the program running for future generations with no additional burden on taxpayers. It's how the VA can afford to guarantee all these loans. The fee is a percentage of the loan amount and it varies. For a first-time user with zero down payment, it's currently 2.3%. If you put some money down, the fee gets smaller. If you use the benefit a second time, the fee is higher, currently 3.6%. Now, 2.3% of a $400,000 loan is over $9,000. That's a significant amount of money. But, and this is key, in most cases you don't have to pay it out of pocket. The funding fee can be rolled right into the total loan amount. So while it does increase your loan balance and your monthly payment slightly, it doesn't prevent you from getting into the home with no cash up front. And there's an incredibly important exception to this fee. Veterans who receive VA disability compensation are completely exempt from paying the VA funding fee. For these veterans, the loan becomes even more beneficial. A true zero down, no PMI, no funding fee mortgage. The other major requirement involves the property itself. The VA isn't going to guarantee a loan on a dilapidated, unsafe house. They require a VA-certified appraiser to inspect the property to make sure it meets what they call minimum property requirements, or MPRs. The home must be safe, structurally sound, and sanitary. The appraiser will check things like the roof, the electrical system, the plumbing, and for any signs of termites. This is for your protection as much as it is for the VA's. They don't want to back a loan on a money pit, that will cause financial hardship for a veteran family. This means that sometimes, extreme fixer-uppers won't qualify for a VA loan until certain repairs are made. So let's put it all together. The VA loan is an unparalleled tool for those who have served our country. It removes the biggest barriers to homeownership, the down payment and the monthly cost of mortgage insurance. It's a powerful, flexible, and reusable benefit. It's not just a loan. It's a pathway to building personal wealth and stability that was earned through service. But what if you haven't served in the military? What if you live far from the big cities, out in a small town or a rural area, and you think that because of your location and income, homeownership is just a distant dream? Well, the federal government has another incredible program, a loan designed specifically to build up the heartland of America. A loan that, like the VA loan, also offers the unbelievable possibility of buying a home with zero money down. This is the USDA Rural Development Loan. And before your mind goes there, let me stop you. This is not a loan for farmers. You do not need to own a tractor, you don't need to know how to milk a cow, and you definitely don't need to be buying a 100-acre farm. In fact, that's the single biggest, most damaging myth about this program, and it stops millions of Americans from even considering what might be the most powerful home buying tool available to them. The USDA loan isn't about agriculture. It's about geography. It's about population density. The official goal is to improve the economy and quality of life in rural America. And the government's definition of rural is probably a lot bigger than you think. So what is the catch? Because zero down payment sounds too good to be true. Well, there are two major requirements that set this loan apart from all others. First, the property itself must be located in a USDA-eligible area. Second, your household income must be below a certain limit. Let's break those down, because this is where the secrets to this loan are hidden. First, the location. This is the big one. The USDA has a map on their website, and I highly recommend you look it up. It's a map of the entire United States, and it shows clear as day which areas are eligible and which are not. You might be picturing tiny towns in the middle of nowhere, but what you'll actually see will shock you. You'll find that vast swaths of suburban America, the outskirts of major metropolitan areas, and entire towns just a 30-minute drive from a bustling city center are all shaded in as eligible. Why? Because the maps are based on census data, and they can be slow to update. A town that was considered rural 10 years ago might now have a Target, a Starbucks, and 3 new housing developments, but it could still be eligible for USDA financing. This creates incredible pockets of opportunity. You could be looking at a house in a beautiful suburban neighborhood with great schools and all the amenities, and because it falls just outside a certain line on a government map, you can buy it with no money down, while the identical house 2 miles down the road would require a massive down payment. It's like a treasure map for affordable housing, and most people don't even know it exists. They just assume, oh, I live near a city, so that's not for me. You have to check the map. It's the first and most important step. The second major requirement is the income limit. And this is where the purpose of the loan becomes crystal clear. This program is specifically designed to help low to moderate income families. Unlike a conventional loan where making more money is always better, here there's a ceiling. The government sets a limit on how much your entire household can earn in a year to be eligible. This limit changes based on the county you're buying in and the number of people in your household. In a more expensive area, the income limit will be higher. If you have more kids, the limit will be higher. Now, some people see this as a disqualifier. They think, oh, I probably make too much. But again, you have to check. The limits are often much more generous than you'd expect. For a family of 4, the limit can easily be over $100,000 in many parts of the country. This isn't a program for the impoverished. It's a program for the working class. It's for the teacher, the firefighter, the factory worker, the young family just starting out who has good credit and a stable job, but just hasn't had the 20 years needed to save up a massive down payment. The government is essentially saying, we want you to be able to build a life and put down roots in these growing communities, so we're going to remove the biggest barrier to entry, the down payment. So let's put it all together. Imagine a young couple. He's a mechanic, she's a nurse's aide. They have 2 kids and a steady income of $90,000 a year. They've been renting a cramped apartment in the city, saving every penny, but they only have about $5,000 to their name. A 3% down FHA loan on a starter home is barely within reach, and the monthly PMI would be crippling. They feel stuck, but then they discover the USDA loan. They pull up the eligibility map and find that the town just one exit further down the highway a place with slightly bigger yards and a highly rated elementary school, is entirely within a USDA zone. They check the income limits for that county and find that for a family of 4, the limit is $110,000. They are well under it. Suddenly, the entire game has changed. They can now buy that 3-bedroom house they were dreaming of with literally $0 for a down payment. The $5,000 they saved can now go towards closing costs, moving expenses, or furnishing their new home. For them, this loan isn't just a financial product. It's the key that unlocks the American dream. Of course, it's not free money. The USDA program is a government-guaranteed loan, which means it works a lot like an FHA or VA loan. A private bank or credit union gives you the money, and the USDA promises to pay them back if you default. To fund this guarantee, the USDA charges its own form of mortgage insurance. Comes in 2 parts. First, there's an upfront guarantee fee, which is a percentage of the loan amount. As of now, it's about 1%. The great news is you don't have to pay this out of pocket. It can be rolled right into your total loan balance. Second, there's an annual fee, which is broken up and paid monthly with your mortgage payment. Right now, it's about 0.35% of the loan balance. Now, here's the kicker. Both of these fees are typically lower than what you would pay on an FHA loan. So you get the benefit of a 0 down payment, but with a potentially lower monthly payment than the other low down payment option. Credit-wise, the USDA itself doesn't set a minimum credit score, but the lenders who actually issue the loans do. In general, you'll want to have a credit score of 640 or higher to get streamlined approval through their automated underwriting system. It's possible to get approved with a lower score, but it will require a lot more paperwork and a manual review by an underwriter. So, who is the USDA loan perfect for? It's for the individual or family with stable income and decent credit, who just doesn't have a pile of cash for a down payment. It's for the person who wants a little more space, a yard for their kids or their dog, and is willing to live in a suburban or small-town community to get it. It's for anyone who feels trapped by high rent and thinks homeownership is a decade away. Who should avoid it? If you have your heart set on living in a high-rise condo in downtown Chicago or the middle of Manhattan, this loan won't work. The geographic restrictions are absolute, and if your household income is very high, you simply won't qualify. This loan has a very specific mission, and if you fall outside that mission, you'll need to look elsewhere. The FHA, the VA, and the USDA loans are the 3 pillars of government-backed mortgages. They use the power of a federal guarantee to open the doors of homeownership to millions who might otherwise be locked out. They are incredible tools, but they aren't the only option. In fact, they aren't even the most common option. The majority of home loans in America fall into one giant category, the one you've heard about your whole life. The one that's seen as the gold standard, the conventional loan. But qualifying for one is a completely different ballgame. The rules are stricter, the requirements are higher, and the down payment myth is stronger than ever. So how do you get one? And is it actually better than these government programs we've just discussed? The answer is, it's complicated. Let's unravel that complication right now. We're stepping away from the world of government-backed loans and into the private sector. This is the territory of the conventional loan, the one you probably hear about the most. A conventional loan is, in its simplest form, any mortgage that isn't insured or guaranteed by a federal government agency like the FHA, VA, or USDA. Instead, these loans are funded by private lenders like banks, credit unions, and mortgage companies, and they follow guidelines set by 2 giants of the mortgage world, Fannie Mae and Freddie Mac. Now, when you hear conventional loan, what's the first number that pops into your head? For 99% of people, it's 20% down. This is single-handedly the most pervasive and intimidating myth in all of real estate. The idea that you absolutely must have 20% of the home's purchase price saved up in cash to even think about getting a conventional loan. This myth has stopped more people from becoming homeowners than almost any other single factor. And I'm here to tell you it is just that, a myth. You can absolutely get a conventional loan with less than 20% down. In fact, programs exist like the Conventional 97 that allow qualified first-time homebuyers to put down as little as 3%. You heard that right, 3%. So why does the 20% number even exist? Why is it so ingrained in our culture? Comes down to 2 letters P, M, I. Private mortgage insurance. Think of it this way. When a lender gives you a massive loan to buy a house, they're taking a risk. If you stop paying, they have to go through the costly and difficult process of foreclosure. Their biggest protection against loss is your equity in the home. The the part you own outright. If you put 20% down, you have a significant amount of skin in the game from day one. You're less likely to walk away. And if you do, the lender has a 20% cushion to absorb the costs of selling the home. But if you only put down, say 5%, the lender's risk is much, much higher. A small dip in the housing market could leave you owing more than the house is worth. That's where PMI comes in. Private mortgage insurance is an insurance policy that you, the borrower, pay for, but it protects the lender. Doesn't protect you at all. If you default on your loan, PMI pays a portion of the lender's loss. It's the price you pay for the privilege of a lower down payment. It's the key that unlocks the door to a conventional loan for millions of people who haven't spent a decade saving up a massive nest egg. This probably sounds a lot like the mortgage insurance premium or MIP we talked about with FHA loans. And you're right, the concept is similar. But there is one monumental, game-changing difference that makes conventional loans so attractive. With an FHA loan, if you put down less than 10%, you pay that mortgage insurance for the entire life of the loan. 30 years of an extra fee tacked onto your payment. But with a conventional loan, PMI is temporary. This is the holy grail. The light at the end of the tunnel. Under the Homeowners Protection Act, your lender is required to automatically terminate your PMI once your loan balance is scheduled to reach 78% of the original value of your home. This means once you've paid your mortgage down and have 22% equity, that PMI payment disappears. Poof, gone. Your monthly mortgage payment goes down, and that money goes right back into your pocket. Even better, you don't have to wait for it to happen automatically. You can be proactive. Once your loan balance hits 80% of the home's original value, you can formally request that your lender cancel the PMI. Now, what if your home's value has shot up since you bought it? You might get to that 20% equity mark much faster through market appreciation. In that case, you can contact your lender, pay for a new appraisal to prove the home's current value, and if that new value gives you 20% equity, you can request to have the PMI removed. This single feature, the ability to eliminate mortgage insurance, is often the deciding factor for borrowers with good credit choosing a conventional loan over an FHA loan, even if the down payment is slightly higher. So, to get a conventional loan, you don't need 20% down, but you do need a solid financial profile. Because these loans aren't backed by the government, lenders are pickier. Generally, you'll need a higher credit score, typically 620 at the absolute minimum, but you'll find much better interest rates in terms with a score above 700, and especially above 740. Lenders will also scrutinize your debt-to-income ratio more closely and want to see a stable employment history. Now let's add another layer. Within the world of conventional loans, there are two main categories: conforming and non-conforming. This sounds like technical jargon, but it's a really simple concept. Remember Fannie Mae and Freddie Mac? These are government-sponsored enterprises that buy mortgages from lenders. This frees up the lenders' money so they can go out and make more loans to more people. It keeps the whole housing market liquid and moving. But Fannie and Freddie have rules. They will only buy loans that conform to their standards. One of the biggest rules is the loan amount. Every year, a federal agency sets the conforming loan limit. This is the maximum loan amount that Fannie and Freddie will buy. For most of the U.S. in 2023, for example, that limit for a single-family home was $726,200. In certain high-cost areas, think San Francisco, New York City, parts of Colorado, that limit is pushed higher, sometimes over $1 million, to reflect the local real estate market. Any conventional loan that falls at or below this limit is a conforming loan. It's the most common type of mortgage in America. It's the vanilla standard issue home loan. But what happens if you need to borrow more than that? What if the house you want costs $1.5 million and the conforming limit in your area is only $1 million? Then, my friend, you are entering the world of non-conforming loans, most famously known as jumbo loans. A jumbo loan is exactly what it sounds like, a giant loan. Because it exceeds the conforming loan limit, it can't be sold to Fannie Mae or Freddie Mac. This means the lender who gives you the loan has to keep it on their own books. They are holding all of the risk themselves. And because the risk is so much higher, the requirements to get a jumbo loan are significantly stricter. Forget the 620 credit score. For a jumbo loan, lenders are often looking for scores of 700, 720, or even higher. They're not just looking at your score but your entire credit history. Forget 3% down. While some exceptions exist, a down payment of 10, 15, or even 20% is standard for a jumbo loan. And finally, they want to see cash reserves. Lenders will want you to prove you have enough liquid cash in the bank to cover 6 to 12 months of your new, very large mortgage payment, even after you've paid your down payment and closing costs. Jumbo loans are for high-income, well-qualified borrowers buying expensive properties. They are the big leagues of the mortgage world. So, to circle back to our original question, is a conventional loan better than a government program? The answer truly is, it depends on you. If you have a strong credit score, a stable income, and can put down at least 3 to 5%, a conventional loan is very often the superior financial choice in the long run, primarily because you can get rid of that pesky PMI. But if your credit is a little bruised, or you need the more lenient debt-to-income ratios, an FHA loan might be your only and best path to homeownership. It's not about which loan is best in a vacuum. It's about which loan is best for your specific financial snapshot at the moment you're ready to buy. But there's another type of loan we haven't touched on, one that offers a unique blend of features from both fixed rate and, well, something a little less predictable. It can be a powerful tool, but it also carries a type of risk we haven't discussed yet. This is an adjustable rate mortgage, or an ARM, and the risk it carries is the risk of uncertainty. Unlike a fixed rate mortgage where your principal and interest payment is set in stone for 30 years, an ARM is a shapeshifter. It starts one way and transforms into something else entirely down the road. Let's break down this financial chameleon, because understanding it could either save you a fortune or cost you dearly. An ARM typically starts with the siren song, an introductory interest rate that is significantly lower than the going rate for a 30-year fixed mortgage. This is often called the teaser rate. If the average 30-year fixed is at 7%, you might find an ARM offering a rate of 5 or 5.5%. On a $400,000 loan, that difference is massive. We're talking hundreds of dollars a month in savings. It's incredibly tempting. For an initial period, usually 3, 5, 7, or even 10 years, that low rate is fixed. Your payment is predictable, you're saving money, and everything feels great. This is the honeymoon phase. But honeymoons end. After that initial fixed period is over, the adjustable part of the name kicks in. Your interest rate is no longer locked. It will now adjust periodically, usually once every year, based on the movements of a specific financial index. This is the core mechanism you have to understand. Your new interest rate isn't just a number the bank pulls out of a hat. It's calculated with a simple formula: index plus margin. Let's look at the two pieces of that puzzle. First, the index. This is a benchmark interest rate that reflects general market conditions. Think of it as the wholesale cost of money for banks. For many years, the most common index was called LIBOR, but that's been phased out. Today, you'll most likely see an index like the Secured Overnight Financing Rate, or SOFR. You don't need to be a Wall Street trader to understand this. All you need to know is that this index goes up and down with the broader economy. When you hear on the news that the Federal Reserve is raising rates to fight inflation, indexes like SOFR tend to rise too. When the economy is slowing and the Fed cuts rates, the index will fall. Your mortgage rate is now tied to this roller coaster. The second piece of the formula is the margin. This is a fixed number of percentage points that the lender adds to the index. If the index is the wholesale cost, the margin is the lender's markup. It's their guaranteed profit on the loan. The margin is set in your loan agreement, and unlike the index, it never changes for the life of the loan. So, if the SOFR index is at 4% and your margin is 2.5%, your new interest rate would be 6.5%. If the index climbs to 5% next year, your rate becomes 7.5%. If it falls to 3%, your rate drops to 5.5%. Your payment will be recalculated each time the rate adjusts, and it will change accordingly. Now, hearing this, you might be thinking, this sounds terrifying. What's to stop my rate from shooting up to 20%? And that's where the most important safety feature of an ARM comes in: the caps. An ARM has a series of caps that limit how much your interest rate can change. Think of them as the safety rails on that roller coaster. There are typically 3 caps you need to know, and they're usually expressed as a series of 3 numbers like 2/2/5. The first number is the initial adjustment cap. This controls how much the rate can increase the very first time it adjusts after your initial fixed period ends. In our 2/2/5 example, the rate can't jump more than 2 percentage points at that first adjustment, no matter what the index has done. So if your starting rate was 5%, the highest it could go in that first change is 7%. The second number is the periodic adjustment cap. This limits how much the rate can increase in any subsequent adjustment period, which is usually every year after the first. Again, in our example, it's 2%. So from one year to the next, your rate can't jump by more than 2 percentage points. This prevents a single catastrophic spike in your payment. The third and final number is the lifetime cap. This is the absolute ceiling your interest rate can ever reach over the entire life of the loan. In our 2/2/5 example, the lifetime cap is 5 percentage points. This means that if your initial rate was 5%, your rate can never ever go higher than 10%, regardless of what happens in the economy. It's the ultimate safety net. So who on earth would choose this path of potential volatility over the bedrock stability of a fixed-rate loan? Well, an ARM can be a brilliant financial tool for specific people in specific situations. Let's say you're buying a starter home and you are almost certain you're going to sell and move in 5 to 7 years, maybe because of a job relocation or a growing family. Why pay a higher interest rate for 30 years of stability you don't need? You could take a 7-year ARM, enjoy a significantly lower payment for the entire time you live in the house, and sell it before the rate ever has a chance to adjust. You get all the upside of the low introductory rate with none of the long-term risk. Or perhaps you're a young professional like a doctor just finishing residency. You expect your income to increase dramatically in the coming years. An ARM allows you to afford more house now with a lower initial payment, and you're confident you'll be able to comfortably handle higher potential payments in the future when your salary grows. You're essentially betting on yourself. ARMs can also be strategic in a high interest rate environment. If you believe rates are at a peak and will likely come down in the next few years, taking an ARM allows you to get in the game with a lower initial rate and then benefit when rates and your payment potentially fall later on without the cost and hassle of refinancing. However, the risk is real. If you are on a tight, fixed budget and the thought of your mortgage payment increasing by several $100s a year keeps you up at night, an ARM is not for you. The peace of mind that comes with a fixed-rate mortgage is invaluable in that case. If you plan on living in your home for the long haul 10, 20, or 30 years, the long-term odds suggest a fixed-rate loan is almost always the safer, more prudent choice. The financial crisis of 2008 was fueled in part by exotic types of ARMs given to people who couldn't handle the payment shock when the rates adjusted. The ARMs of today are much safer and more regulated, with stronger consumer protections like those caps we discussed, but the fundamental risk of a rising payment remains. The most common types you'll see are called hybrid ARMs, often listed as a 5/1, 7/1, or 10/1 ARM. The first number tells you how many years the introductory rate is fixed. The second number tells you how often the rate adjusts after that initial period is over. So a 7-to-1 ARM is fixed for the first 7 years, then adjusts once every 1 year thereafter. It's a hybrid, giving you a medium-term period of stability followed by long-term flexibility or volatility, depending on your perspective. Choosing between fixed and adjustable is about more than just the numbers. It's about your personal financial situation, your future plans, and your tolerance for risk. It's a calculated gamble. But a conventional fixed-rate loan and an ARM both generally assume one thing: that you have a solid credit score and can afford a significant down payment, often as much as 20% of the home's price. But what if that's your biggest hurdle? What if you have good income, but you just haven't been able to save up $100,000 for a down payment? What if you're a veteran who has served the country, or you want to buy a home in a more rural community? The standard rules we've been discussing, they don't always apply. There's a whole other category of mortgages, backed by the full faith and credit of the US government, designed to open doors that conventional loans sometimes keep shut. And these government-backed loans aren't just a niche product. They are a massive, fundamental part of the American housing market. They step in where the private market hesitates, guided by a mission not of profit, but of policy, to promote homeownership for everyone. Think of them as 3 distinct keys, each designed to unlock a very specific type of door: the FHA loan, the VA loan, and the USDA loan. Let's start with the most famous one, the one you've almost certainly heard of, the FHA loan. The FHA, or Federal Housing Administration, doesn't actually lend you the money. That's a common misconception. Instead, they insure the loan for the bank. They tell the lender, hey, go ahead and lend to this person. Even if their credit isn't perfect or their down payment is small, we've got your back. If they default, we'll cover your losses. This insurance is the magic ingredient. It gives lenders the confidence to say yes to borrowers they might otherwise turn away. So, who is the FHA loan for? It's often called the first-time homebuyer's loan, and for good reason. It's the ultimate foot in the door. Imagine you're a recent college graduate. You've landed a good job, you're paying your bills, but you haven't had decades to build a flawless credit history. Maybe your score is in the low 600s, and saving up 20% for a down payment? In today's market, that could take a decade. For you, the conventional loan door might be locked shut, but the FHA door swings wide open. With an FHA loan, you can potentially get approved with a credit score as low as 580, and you only need a 3.5% down payment. On a $300,000 home, that's the difference between saving $60,000 and saving just $10,500. It's a game changer. It's the difference between renting for another 5 years and starting to build your own equity right now. But, as with everything in finance, there's no free lunch. The cost for this amazing access is something called MIP, or mortgage insurance premium. And this is critically important to understand. Unlike the PMI on conventional loans that eventually goes away, FHA's MIP is a bit stickier. Comes in 2 parts. First, there's an upfront mortgage insurance premium, which is a percentage of the loan amount that's typically rolled into your total mortgage. You don't pay it out of pocket, but it does increase your loan balance. Second, and more importantly, is the annual MIP, which is paid monthly for the life of the loan in most cases. Yes, you heard that right. For the entire 30 years, you'll be paying that extra fee every single month, unless you put down 10% or more, in which case it lasts for 11 years. The only way for most FHA borrowers to get rid of it is to one day refinance into a conventional loan once they have enough equity. So the FHA loan is a phenomenal tool to get you into the house, but the long-term strategy often involves moving out of it financially. Now let's shift gears to what is, without a doubt, the single best mortgage product on the planet, but it's one you have to earn. This is the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, this is a benefit for those who have served our country, eligible active duty personnel, veterans, and some surviving spouses. And when I say it's the best, I'm not exaggerating. The headline feature, the one that drops jaws, is this 0% down payment. Not 3.5%, not 3%, 0. A qualified veteran can buy a home with absolutely no money down. This benefit is so powerful it can literally change the entire financial trajectory of a military family, allowing them to buy a home and start building wealth in a new city after a permanent change of station, without having to drain their life savings. But it gets even better. With the VA loan, there is no monthly mortgage insurance. None. That MIP we just talked about with FHA loans? Gone. That PMI from conventional loans? Doesn't exist here. This alone can save hundreds of dollars every single month compared to other low down payment options. The VA also has some of the most forgiving credit requirements of any loan type. Because the loan is guaranteed by the government, lenders can be more flexible. So what's the catch? Is there one? Sort of. Instead of mortgage insurance, most borrowers will pay a one-time VA funding fee. This fee helps keep the program running for future generations of service members. The exact percentage varies based on your service, your down payment amount, and whether it's your first time using the benefit. But, and this is a big but, it can be rolled into the loan amount. And, crucially, veterans receiving VA disability compensation are completely exempt from paying it. So for many of our nation's heroes, it truly is a zero down, zero mortgage insurance, no funding fee loan. It is the nation's promise fulfilled. A powerful thank you delivered in the form of a mortgage. Finally, let's talk about the sleeper hit of the government-backed world. The loan that many people don't even know exists. The USDA loan. This program from the U.S. Department of Agriculture isn't for buying a farm, which is a common assumption. It's designed to promote homeownership in less dense areas. Think rural communities and even some of the suburban towns right on the edge of major cities. And the USDA loan shares a superstar feature with the VA loan. Zero down payment. 100% financing. For a family that wants more space, a quieter life, and a good school district, but doesn't have a big nest egg for a down payment, the USDA loan can seem like a miracle. But this miracle comes with 2 very specific, very firm requirements. First, the property itself must be located in a USDA-eligible area. You can't use it to buy a condo in downtown Manhattan. The USDA has eligibility maps online, and you might be shocked at how much of the country qualifies. Many small towns and suburbs just outside of major metropolitan areas are included. The second requirement isn't about the property, it's about you. There are household income limits. Unlike other loans where making more money is always better, for a USDA loan, your household can't earn too much. The program is targeted at low to moderate income families, so it has this unique dual gate system. The house must be in the right place, and your income must be in the right range. If you can pass through both gates, you get access to a zero-down loan with very low monthly mortgage insurance rates, making it one of the most affordable paths to homeownership available. So you have these 3 powerful government tools. The FHA, the great accessible option for those with lower credit or savings. The VA, the incredible hard-earned benefit for our military community. And the USDA, the hidden gem for building a life outside the concrete jungle. They are the great equalizers in the housing market. But what if you don't fit into any of these boxes? What if the house you want to buy is $1 million property, far exceeding the limits of a conventional loan? Or what if your financial situation is truly unique? Maybe you're a self-employed entrepreneur with fluctuating income that a traditional lender just can't understand. For these situations, we have to leave the world of standard, government-backed and conventional loans behind and step into the wild side of lending. This is the world of non-qualified mortgages, or non-QM loans. To understand what they are, we first have to understand what they are not. After the 2008 financial crisis, the government created a set of rules under the Dodd-Frank Act to make lending safer. These rules established the qualified mortgage, or QM. A QM loan is a mortgage that meets certain strict requirements, proving the lender made a good faith effort to determine you have the ability to repay it. Think of it as the gold standard for safety and stability. It requires verifiable income using tax returns, W-2s, and pay stubs, and it has caps on how high your debt-to-income ratio can be. A non-QM loan, then, is simply any home loan that doesn't meet those rigid QM standards. It doesn't mean it's a bad loan or a dangerous loan. It just means it uses alternative methods to verify your ability to repay. These are the creative financial tools for people whose lives don't fit neatly into a W-2 box. Let's start with that self-employed entrepreneur. You're a graphic designer, a consultant, a YouTuber, whatever. You make great money, but on paper it's a mess. Your tax returns are a masterpiece of legal deductions designed to lower your tax bill. You write off your home office, your equipment, your travel. The problem is, when you hand that tax return to a conventional lender, they see the net income after all those deductions, not the gross cash flow that's actually hitting your bank account. They see you making $30,000 a year, while you know you're actually living on $150,000. For you, the solution is a bank statement loan. Instead of your tax returns, the lender will ask for 12 or, more commonly, 24 months of your business or personal bank statements. They won't look at your deductions. They will look at your deposits. They'll add up all the deposits over that 24-month period, average them out, and use that as your monthly income. It's a common-sense approach that reflects your real cash flow, not your taxable income. Now, they won't count every single dollar. They'll apply an expense factor, say 50%, assuming that half your revenue goes to business expenses. But even so, for many entrepreneurs, this method qualifies them for a loan that would have been completely out of reach otherwise. It's the key that unlocks homeownership for the backbone of the American economy, the small business owner. Okay, next scenario. What if you're a retiree? You spent 40 years building a massive nest egg. You have $2 million in a stock portfolio and another $1 million in retirement accounts. But your actual income is just a $2,000 a month Social Security check. A traditional lender looks at your $24,000 annual income and laughs you out of the office. But you're sitting on $3 million. This is where an asset-based loan, sometimes called an asset depletion or asset qualification loan, comes in. The lender will look at your qualified assets, stocks, bonds, mutual funds, retirement accounts, and use a formula to turn that pile of wealth into a monthly income stream for qualification purposes. They might, for example, take your total asset value, divide it by a certain number of months, like 360, the life of the loan, and treat the result as your monthly income. So that $3 million in assets could be turned into over $8,000 a month in qualifying income, which is then added to your Social Security check. Suddenly, you're not just a low-income retiree. You're a highly qualified buyer with substantial assets to back you up. It allows you to leverage the wealth you've built over a lifetime without having to liquidate it and create a massive tax event just to buy a home. Now let's talk about the real estate investors. You've found a perfect rental property. It's a duplex that you know will generate $3,000 a month in rent. The problem? You already have a primary mortgage and a few other investment properties, so your personal debt-to-income ratio is already high. You don't need a loan based on your income. You need a loan based on the property's income. This is the magic of a DSCR loan. DSCR stands for Debt Service Coverage Ratio. It's a simple but powerful idea. Does the property generate enough income to cover its own debt? With a DSCR loan, the lender almost doesn't care about your personal W-2. They don't ask for tax returns or pay stubs. They care about one thing: the ratio. The formula is the property's net operating income divided by its total debt service, which is just a fancy term for the mortgage payment, principal, interest, taxes, and insurance. Let's say the gross rent is $3,000 a month, and the total mortgage payment is $2,000. Your DSCR would be $3,000 divided by $2,000, which is 1.5. Most lenders want to see a ratio of at least 1.25, meaning the property generates 25% more income than its expenses. A ratio of 1.5 is fantastic. If the ratio is less than 1, it means the property loses money every month, and you won't get the loan. DSCR loans are how professional real estate investors scale their portfolios. They can buy property after property based on the merits and cash flow of each deal, not on the limitations of their personal salary. Finally, let's touch on a loan type that got a bad reputation after 2008, but is making a comeback in the non-QM space for the right borrower. The interest-only loan. For a set period, typically the first 5, 7, or 10 years of the loan, your monthly payment consists of only the interest. You are not paying down a single penny of the principal balance. The result is a dramatically lower monthly payment during that initial period. This can be a strategic tool for someone with a high net worth who wants to maximize their cash flow for other investments, or for someone who anticipates a significant jump in income in the near future, like a medical resident about to become a full-fledged surgeon. But here is the critical warning. When that interest-only period ends, you face payment shock. Your payment will suddenly skyrocket because you now have to start paying back all that principal, but in a shorter amount of time, say 20 years instead of 30. If you haven't planned for it, it can be financially devastating. This is not a tool for stretching your budget to buy more house than you can afford. It's a specialized product for a sophisticated borrower with a clear financial plan. So, the wild side of non-QM lending isn't really that wild. Just logical. It's a world of customized solutions. But what's the catch? The catch is risk. Because these loans fall outside the government-protected QM box, lenders view them as slightly riskier, and they price that risk into the loan. You can generally expect a non-QM loan to have a higher interest rate, require a larger down payment, often 20% or more, and may come with higher closing costs than a conventional or FHA loan. It's a trade-off. You get flexibility, but you pay a premium for it. And so, here we are at the end of our journey. We've traveled from the bedrock of American homeownership, the 30-year fixed-rate mortgage, to the government-backed accessibility of FHA, VA, and USDA loans. We've explored the flexibility of ARMs, the scale of jumbo loans, and finally the creative problem-solving world of non-QM financing. The single most important lesson in all of this is that there is no such thing as the best type of mortgage. There is only the mortgage that is best for you, for your story, for your specific financial chapter. Are you a first-time buyer with little saved up? An FHA loan might be your key. A veteran? The VA loan is a benefit you've earned. Are you a high-income earner buying in an expensive area? A jumbo loan is your tool. A self-employed hustler building an empire from your laptop? A bank statement loan understands your grind. Your power as a homebuyer doesn't come from memorizing every single detail we've discussed. It comes from knowing that these options exist. It comes from the confidence to walk into a lender's office, or more importantly, a mortgage broker's office, and not just ask, "What do I qualify for?" but to say, "Here's my situation. Which of these tools is the right one to build my future?" You are now armed with a vocabulary and a framework to understand one of the biggest financial decisions of your life. You can cut through the jargon and the sales pitches. You can ask intelligent questions and demand better answers. Homeownership can feel complex and intimidating, but at its core, it's about finding the right key for the right lock. And now you have a whole ring of keys. Go find your door.